Well, welcome back to another episode of Not Done. This is Sloan Dean, your host, and today my guest is a expert in all things hotel investments and advisory, president and CEO of Hunter Hotel Advisors, Teague Hunter, and Teague also has a very infamous and incredible podcast himself, Teague Talks. So you've probably seen him out there as well. So Teague, welcome to the show.
Sloan, thank you for having me. Not done. That's a great introduction. My dad couldn't have done it any better. So thank you for the kind words.
Yeah. So actually, we'll start with your dad. Your dad, Bob, founded Hunter Hotel Advisors in '78. What was that pivotal moment where you realized that maybe the family business was where you were supposed to be?
Yeah, so I think, and again, thanks for having me. Maybe I'll back up and I'll tell a lot of stories. But so dad worked at IBM and left when his youngest son was born and said, I'm going to go jump into real estate, not knowing what he meant by real estate. And so when you're in real estate at that time, so this is in the 70s, you're doing an office building, an apartment, you're doing a retail, a liquor store, a convenience store, you're doing what have you. And then he did a hotel for a bank. A bank took a hotel back in foreclosure. He sold the hotel and he said that felt different. And that's when he put up a shingle and said, IR hotel broker.
IR hotel broker.
So I was born in 73. So for 5 years, dad was just a real estate guy. And in 78, he actually said, I'm going to do hotels, just hotels. I'm a specialist. And he would tell you that the RTC days happened and the banks were taking lots of stuff back. And he was their go-to guy for hotels. My story's similar. I mean, I grew up in the business with dad and we would drive to the beach and stop 6 times between Atlanta and Ormond Beach or Daytona. We'd stop and look at hotels, and that's just what I knew growing up. I remember when he started the conference, he was like, do I do this or do I not? And I was like, this is a great idea. And Lee was like, don't do it. Why would you do that? Sounds like a lot of work. But I then I really went to IBM when I graduated. I was at Merrill Lynch. I realized that was dealing with people's money, and your money is expensive. The company's money is very cheap. So I was like, I'm going to go deal with business to business sales. And I said, let's go to IBM. Dad was there. Mom was still there. So she helped get me a job. And I thought technology was the future. I quickly realized that corporate America was not for me. I was just an entrepreneurial spirit. I wanted to be free. I wanted to go do my own thing. I wanted to be in charge of my own destiny, even if that meant that I failed. I didn't care. So after being at IBM for 3 years and realizing what I didn't want to do, I came and begged dad for a job. Not, hey, you do hotels? I'm down to do hotels. It was, what do you do again? That's great. I'm all in. Let's go figure this out. So I can remember showing up, joining dad, and it's just the two of us. And that's a little bit of a lie. Nancy Petenbrink was always with him. Warner Smith was there with him, but there was nothing. And I remember selling a hotel and thinking, I'm never going to do that again. That was hard. That was really hard.
Well, you fast forward and your dad retired, I think in 2018. What did your dad tell you before handing it off to you?
I mean, at that time, he probably said, don't screw it up. Yeah, he had, 2018, remember but when dad finally sort of retired and he had to retire, he had to go take care of mom because she'd gotten sick. So he was 100% out. And yes, Lee and I had been running the firm for a decade up before that, but you still had dad there. Even at the very end, it was dad. And he made the final decision and it was his name on the bank account. And he was the one writing the checks, and the buck really stops here. And the checkbook, it was now from the Bank of Bob, it was the Bank of Teague. And if we're writing a check, Teague is literally writing the checks. It's a different feeling. It just is.
I'm sure. And, you and your brother Lee now have worked together for years. I'm curious, how does that work? And how have you guys made that work? I have an older brother, David. We don't do business together, but we're distinctly very different. He's been very successful in his own accord, not in hotels. You guys are very different people. Knowing both of you, I'm sure you have different strengths, but how do you make it work?
Yeah, one, family, and you just sort of start there. And the good news is we have history together, right? You and your brother, you grew up together. We grew up together. We knew each other. We're very close. We're 1 year in school apart. He's a year, 18 months older. We have the same friends. You're playing ball together. So
Right.
you just kind of instinctively know each other and you have that chemistry. You also know your strengths and you know your weaknesses. He is very analytical, very mathematic, very sort of conservative, by the book. This is what the math says. And I, for better or for worse, tend to be the opposite. So I am much more
Well, and I
emotional.
think that's probably older or younger sibling too, because it when you're sitting there describing, it feels like you're describing David and myself.
And you know it as the younger one, I could watch my older brother try something. And if he
Right.
failed, his lesson was, well, I'm not going to do that again. And my lesson was, oh, I'm going to do it differently. I saw how you failed. I know what I could do to make that thing work.
I was pulling some numbers for this call and hotel transaction volumes. I think this is a JLL clocked in U.S. hotel transaction volume at 24 billion in 2025. Now, I think because of where interest rates have gone, costs of construction, supply growth has been pretty anemic in the United States. And then transaction volumes really slowed as interest rates took off, and some other factors woven in, call it kind of 23, 24. How are you seeing the transaction market now as we move into 2026?
Yeah, right now in 2026, it's as hot as it's been. There's a ton of assets on the market. Most of that is the sellers. They're tired. They're tired of going through 5 years of COVID or
Right.
2 years of COVID, 3 years of higher interest rates and just tough environment. So most of that is we have sellers, lots of people like, okay, we've done what we can do. We need to sell these assets. 90% of the people calling us, it's a debt issue, whether it's an issue with the bank or just a maturity and or a PIP that's come due. Because the brands were pretty good about the PIPs kicking the can for the last couple of years, and now they're like, no, you got to pay the piper. Time to do these. And I would argue. I mean, for the last couple of years, the publics have spent all their time and capital renovating their assets, right? Asset
Yeah.
managing what they had. They're
Yeah.
not buying anything. They're not selling anything. They're just asset managing what they have. And that honestly, in my opinion, kind of ends up being a bit of a death spiral. Like you can't do that for forever. In the limited service space, they haven't been spending money on their assets and just trying to cash flow and trying to survive and trying to keep value up. And now they don't have a choice. So now they got to spend it. Now the brands are getting pretty tough, but they need to. They also need to. They need to spend the money.
Yeah. It almost feels like some of the asset reinvestment and the asset value reset that really needed to happen post COVID is starting to come to fruition in a meaningful way, over the last 12 months and really throughout 2026. Is that a fair statement, you think?
Yeah, I think it's very fair. I think so golly, I could do a bunch, but I think values really dropped in the peak of the market was June of 2022.
Yep. I remember it well. Yeah.
So, and if we go back, right, like even in 19, business was great. Everybody was doing really well. And then COVID hit and everybody was like, oh gosh, we don't know what's going to happen. And so there was like 9 months in there or really March to September, 6 months, everybody was kind of panicked. And then we printed all this money and all of a sudden people started traveling again very quickly and assets value shot up. We had cheap interest rates and we had tons of capital out there. And so asset value shot up and transaction volume shot up. So 21 and 22 were the most active years for a lot of people. For us, and values were way up in a lot of places. Not all, but in a lot. And then in June of 22, we were too hot. And so we raised interest rates quickly. And I would argue that almost overnight, the values of all real estate everywhere dropped by 20%. And that was in June of 22. And then it just took time, a year, 2 years, 3 years for us to realize, oh, wait, my values dropped 20%.
Right.
Or to admit that the values were off that much. You knew it, but you were like, no, it doesn't feel right. Because yesterday my value was strong and you're telling me today it's off? No, I don't believe that. But it did. It just did. And then I would argue from June of 22 to today, which is almost coming up on 4 years now, values have been dropping every day. Today, I think we're at a bottom and I think we're coming up off of that bottom. And I think there's some green shoots and some lights at the end of the tunnels and all those analogies. So I think we're coming up. But it's still a low spot and it just feels tough. As we say, the hotel industry is hard and it just feels hard right now. But there are senses of optimism out there that everybody's getting behind.
What do you think? So, in terms of total value, what do you think is going to be the trend for like cap rates? I think I'm quoting here, luxury have been holding, call it 7, 8 cap. and you get into some iconic assets and cap rates out the window. You're talking 3, 4 cap, upper upscale 9. It seemed like cap rates have been trending upwards some. What are you seeing with cap rates as we kind of go forward? What should folks expect?
Yeah, so I think sort of in the peak we were in the sixes, right? If not six, and it
Yeah.
again depends on what asset you're talking about, but we think
Right. And there was an anticipation that, this post-COVID demand would continue to expand. So people were buying things on what they thought were a forward 8, but on a trailing basis were maybe a 6, right?
exactly right. Today, I would argue that same number is, call it 8.5. That's sort of where it pencils. As a broad brush, that's sort of where the world is. Having said that, I could argue as a 9, the people doing math, it pencils at a 9. We don't sell at 9s. Now I'm getting into the grays because no one wants to sell for a 9. They're like, I would buy at a 9 cap. I'm not selling for a 9 cap.
Right.
So all of our trades seem to be in the 7s of where we're trading. Call it a 7 cap, but I can't claim that that's market. I claim that we did our job to find the outlier who found extra value there, which we seem to do every time, knock on wood. And so maybe that is value, but I can't with a straight face say that the market is a 7 cap, but that
Right.
seems to be every trade because
Yeah,
we
yeah.
find people that find a reason that they have to have it.
Right. Maybe a geographic concentration, a rebrand. Maybe it's they're the owner operator, can flip out the operator.
It's exactly right. 1031 exchange, next door neighbor. Um, and honestly, our secret sauce is finding people that value things different ways. So we call ourselves translators. We're big between Wall Street and Main Street, but Wall Street is only value on a cap rate. Period. End of discussion. That's the only metric that matters. Main Street looks at replacement cost, cost per key, room revenue multiplier, right? What can I do with this? Or just operational efficiencies. I just can operate it more efficiently. Maybe it's the hotel next door to me. Maybe it's on a beach. I always wanted to buy on a beachfront. I can do something with that, and they just fundamentally look at it differently and try to find value in different ways. And that's our job, is to bring those two people together.
Yeah, no, that's great. That's well said. Now, I know you guys being in Atlanta, and I always think of you guys as like the iconic Sun Belt brokers, but you obviously do business all across the nation. What are kind of the markets that you think about that from a broker's perspective are markets to keep an eye on for the next 12, 24 months?
Yeah, again, my speech is there's no broad brush. Everybody's got to do what works for them. You just do. If you're on the West Coast, don't come east, and if you're in the East, don't go west. We were Southeast. That's where we've been. That's probably now one of the misconceptions because we now have offices in New York, Miami, Austin, Texas, LA, Chicago, all sort of in between. We need more West Coast presence than we do. That's part of our growth strategy. But we're everywhere. And the way we do that, secret sauce, not the question you asked, is Blackstone comes and hires us and says, Teague, we've got 46 hotels. We need you to go sell these. And so we have to put the team together and go. They don't care where they are. They just trust us that we know what we're doing. We know what the values are. We know who the buyers are. And we break it up and we go sell those 46 hotels, mostly onesie twosies, not portfolios, because the portfolio value isn't there, right? It's actually a portfolio discount today. It's coming back a little bit as the capital comes back. There's now more opportunity for portfolios where there haven't been an opportunity for portfolios, but still the highest and best use is onesie twosies. Now, to your market question, it depends on where you are. Even hot markets, I'm going to say New York and San Francisco were down and are now coming back very rapidly. So
Right.
those are big, sexy markets. Those are coming back very rapidly.
No, I was going to say, I agree with you on San Francisco. I think the reframe there is, values there got so hot pre-COVID, 2019, I would even say inflated because of Silicon Valley. But then with the city getting, from homelessness and other things, values have gotten so depressed there that Moscone was out for renovation. So it's almost like you've had such a massive reset. And I mean, some San Francisco assets have lost half their value. So
Correct.
I totally agree with you that like if you can get in now, you've had a complete reset of value in that city.
100%. Actually, the real people that know are already way ahead of that curve.
Right.
So you had to buy when it's still falling, when nobody wants to. Now everybody's kind of like, oh yeah, San Francisco, because AI is coming up so strong.
Exactly.
So they're like, okay. Kind of the same with New York. They've got the union issue always hanging over, but they've got rid of Airbnb. They got rid of all things like that. So New York is coming strong. The other small markets that are out there, though, that you like, there's like Huntsville, Alabama, that has Space Force. So Huntsville is crushing right now. It's doing really well. South Haven, Mississippi, same thing. You're like, what? Why? They've got data centers, they've got stuff happening. It's just growing. There's fun markets like that. Greenville, South Carolina has always been a dominant market. Downtown Greenville, the ADRs are off the charts. It's a little mini Nashville that has yet to be overbuilt.
Yeah, where I grew up in Northeast Georgia is about an hour from Greenville. It is a hidden gem. You have like the little walkable downtown with the river running through it. So
The opposite of that, you didn't ask, but like the Nashvilles are in my opinion still too hot, so they're falling, and I think they haven't found a bottom yet.
when
Miami,
you've had so much supply into Nashville, I mean, it's just nuts. My brother lives in Nashville, and I would go up there 20 years ago when he was in grad school, and the Omni wasn't there. The MCC wasn't there. The the JW, none of those hotels were there. And now I think the downtown supply is like gone, not even 200%. It was like 300% growth since 20 years ago.
and we've been saying that for 20 years. Okay, that it's oversupplied, it's oversupplied, it's
Well,
oversupplied,
now
and
it's happened.
it finally got there. Yeah, it
Yeah.
finally.
Yeah, you're going to say something else. Sorry.
I can't remember. Miami is another one that
Oh, yeah.
everybody's rushed to, and I think it's a little too hot.
Yeah, I guess it depends on your hold period. I always tend to think these Austin, Miami, Nashville, these kind of darlings to get oversupplied. If your hold period is 10, 20 years, you're probably still good. I maybe want to pivot us to, while we're talking about market dynamics, I'm gonna quote this. This is a recent Skift article published April 13th. You may have seen this. It's called "The Squeeze: Inside the Crisis Crushing America's Hotel Owners." Did you see that article?
I don't think I did.
Oh, okay. So it was, it had like some owners quoted. It had the new IHG Owners Association chair quoted. And it just talked about how the hotel owner has seen value leakage, whether that's going to the brands who have done, let's be honest, Marriott, Hilton have continued to hit all-time stock highs. Amazing companies, by the way, good friends of mine. You then have the OTAs have hit all-time stock highs. And like we just talked about, values since 22 have been down, down, down. And I know you say, hey, there's some green shoots on the horizon, and we think values have leveled off. How do you see that world as you're selling for owners and selling to owners, that the last 3-4 years, why margins have kind of crunched on owners? Curious to get your take.
Yeah, it's just that expense creep, right? I mean, way back in the day,
Yeah.
it was breakfast and stuff. Now it's, again, we look at what is controllable and what's not controllable. So the biggest creeps that are concerning are taxes, insurance, things that you can't overly control, like that sort of below the line stuff. That's where we've seen a big issues that, I don't know, you got to have some bigger help.
It seems like those have leveled off too.
Correct. But take just if your taxes were 100,000 and now they're 400,000. Like that's a giant leap, and that's 300.
Apply a cap rate to that. That's a lot of
Exactly
value.
right. Exactly right. Just on a 10 cap on 300,000, that's $3 million in value just because of your taxes.
Yeah. And
Right.
you hope, and I'm sure the city is spending the money well. Anyways, I won't go there. Sorry, I digress. Two Southern guys talking about municipality politics. I won't go there, but back on track.
But it is why people still want to be in the South, and we're seeing the exodus from California. You just are. That's not and Minnesota's a tough place to get a deal done today, as an example. Chicago's a tough place to get a deal done today.
That's right. Yeah, it has. I mean, LA's the classic example too. That unfortunately, probably half the hotels in downtown LA, and these are my own words, by the way, that are not even equity positive because of what's happened with the labor situation there, what the city has done around work rules, taxation, and it's like, you can't have that ecosystem that's so unsustainable. Like it's, so the alternative is the hotel shut down and then there's no tax revenue and there's no jobs. It's like people don't think about that, Anyways, I get on my soapbox, but
yeah, just again, you got to be pro business versus anti. You got to support business if you want business to come and grow in your city or state or whatever.
yeah, and I would think in those cities too, you're like you said, you're probably not getting a lot of sales done because the owner is probably trying to kick the can because their value has maybe been impaired or something else. How do you guys see the debt market these days? Like as you're getting transactions done, the private credit was pretty hot for a while.
Yeah, debt markets are wide open. There is plenty of capital, if not too much capital, chasing debt right now, which is great. So that mere competition is shrinking spreads, compressing spreads, and you're able to get a lot of stuff done. It's still
What kind of loan to value are you seeing these days?
the base model is in that 60, 65, let's call it 65%, and it's L300, but you got to have debt coverage ratios. You got to have check, 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 check. The problem, and the good news, which I think is good news, the reason where private credit comes in is when you don't have all of that, those metrics, when you aren't cash flowing and you need a higher LTV. You need 70, 75, 80. You need some stretch, and they can combine a mezz piece, and all of a sudden you're paying, 9% plus, but you got a loan. Better than not getting a loan. So you're L500 plus. And the opposite of that, if you're an awesome property and you're cash flowing and you got a 12 or a 13 debt coverage ratio, you're in the twos. Some people are starting to see for the right sponsor and the right asset, they're getting south of the twos. Now, L200 minus, like it's that competitive, especially if you get some life company money in there and stuff. They're starting to, but that's not normal. Most of it is is L300.
Well, I think that shows that like lenders are seeing that we're having this value reset, that, you know, it's an opportunistic time for the industry. I mean, I think that is a great signal that you've got the debt markets that can help facilitate a lot of these transactions.
Yeah, it's got to start somewhere. The irony though is we're missing the equity. The equity is not there, and that's a couple of different reasons. One, the owner operator has had trouble. All this stuff we just talked about, the expense creep, the PIPs, so they're not making as much money on their assets that they own as they were. So they don't have as much money in their pocket to go buy the next one with.
Right.
So they're running out of equity capacity. The big boys, the Blackstones and Starwoods, and they're really tight, and they have optionality. They can do industrial, they can do data centers, they can go buy multi, they can go buy tech. Like they don't have to buy real estate. They have optionality. So they fundamentally said, yeah, we don't love the hotel space right now. What they all love, just real fast, is the luxury, ultra luxury market. Right. That is the word of the day. That is where they're all headed. And that's because in this K economy or whatever you want to call it, that guest has not softened. That guest will still pay whatever they need to pay to have the right experience at the right property. So now that's what all the Blackstones and stuff want to buy. And so there's a new, there's heat to that market. There's a new excitement in that market because that's the hot market today. So everybody's trying to go get it. That's also a tough market to value that we'll see. Waldorf Astoria's on the market right now. Everyone's like, we're buying it. It's silly expensive. We'll see if it's there or not. We will see. All the other asset classes, limited service definitely, but even full service, those have already gone through 3 years worth of value finding. So we know what value is. We're not really arguing over it right now. That ultra luxury hasn't been on the market. So they're going through that value discovery at the moment. What is value? And we don't know. We're going to find out who really has to own that and wants to own that and is willing to step up and buy that and pay for it. And that's going to be fun to watch, I think.
Yeah, I agree. And you're right. It'll be really interesting if some of the acquisitions are published, which I guess most would be with Braemar. So it'll be interesting to see what all the Braemar hotels trade for. And then strategic, you just reference, the Waldorf and that those will both be really interesting. I've heard some of the pricing on those, and they're quite aspirational, at least the BOVs. So it'll be interesting to watch.
When you have the stock market at all-time highs, right? Yeah. There's a wealth effect. People feel wealthy, and I'm a big psychological person. If you feel good, you'll do it. If you don't, you won't. So if you're feeling wealthy, you're going to go and you're going to spend. You're like, it's okay. We're going to do it. And if you don't feel good, you're not. And there's plenty of people right now, that's the problem, that are not feeling good. They're again, hotels are hard. We keep saying that. But you Happy Meal, I'm not trying to get negative, but a Happy Meal was $5, right? Now it's $15. Like, what?
Well, yeah. I took all four of my little one, she doesn't eat McDonald's, but my 3 boys, and one's a teenager and one's soon to be a teenager. And it's like $50 for my 3 boys,
Right. That's not how that's supposed to be.
Yeah, it is a bit interesting, the times we're living in. I have to ask you, while we're talking about industry stuff, it does feel, and I've given a hard time to when a few of the brand CEOs have come on my show. There definitely are a lot of brands. We love our hotel brands in America. I think just over 70% of hotel supply is branded. How do you think about that as you're selling a hotel or advising a buyer around, okay, independent versus brand? How do you think about that from your lens?
Oh, loaded question. Part of it, a little bit of a cop out answer is we don't. Like, I'll let that person figure it out and go from there. But I do think it's a really good point to be made. There's a lot of people now going independent, like just no brand. We're going independent, but it's got to be the right hotel in the right market with the right operator owned by the right owner. It
Yeah.
just is. You have to lean into sales. It takes it a lot longer for that asset to ramp up. Okay. If you take an asset and you plug it into the Hilton Marriott IHG system, it just goes. There are brands that are better than others.
Yeah,
And
of course. That's
we
why
can
they're
get
pipes. That's why Hilton and Marriott have NUG growth of 6 to 7%, and the other brands are sub 3. I mean, it's just the numbers are the numbers. They don't lie, right?
and they're going to open up another one. Marriott's going to come up with a City Express to kick all their Fairfields and Courtyards down
Right.
to.
Right.
Hilton came up with Spark to kick all the Hamptons down to, and they have to because that's a thing coming. Again, we learn from Holiday Inn. Holiday Inn let their stuff get old. The reason Hampton Inn exists, the reason Holiday Inn Express exists, is because the Holiday Inn, which was the dominant roadside hotel in the industry, got old, and they wouldn't kick them out of the system. And so here comes a brand new shiny one. We just made it up, and boom, it took over, and Hampton Inn took over, and it took off. And then Holiday Inn was too late to respond, but they eventually got Holiday Inn Express in there, and that worked. So now
Yeah.
we're seeing stuff I can't say, but I'm gonna just pick on the obvious ones. You have AC and Courtyard. AC will just beat out Courtyard. Marriott would say, no, Courtyards are fine. They have their spot. Well, okay, how about Fairfield? No, it's got its spot. Okay, but it's not. We're all going to transit up to new. So all they did was came in with AC and cannibalized their own brand.
Well, and we've seen that too, right? You know,
Yeah,
I think
correct.
AC has been one of their most successful brands. I mean, and they perform exceptionally well. I think it's really interesting. I mean, I've called for, and this is my own prediction, that in this time of AI and consumerism that there'll be more consolidation, that, you know, you have kind of oligopolies at the brand. You have Marriott and Hilton at one level and everybody's kind of tiered below that. Hyatt's done an exceptional job, I think, Mark and the team, of elevating and doing smart transactions like the Playa. I tend to think that there'll be more consolidation is my take. I guess time will tell.
I'll take the under on that. I don't think they're going to consolidate. They'll have 100 brands.
They just organically, it's better for them to go incubate something and sell it like hotcakes instead of going and paying 12 times for something that's got old product.
Yes.
That's fair. I always have said I thought Accor and IHG would make a lot of sense because IHG's got this dominant American presence with Holiday Inn Express, and Accor is dominant in Europe and South America. And it's almost like geographically they would pair well, but who knows?
No, so this is interesting. God, people probably don't care, but let's go. So I very much agree with you. That consolidation should happen. Okay, they really just should. And even if not, Hilton should jump in and gobble them both up. Okay, so and Hyatt should jump in there. You certainly need Choice and Wyndham. They tried it a couple years ago. They need to be merged. They just do. But you have egos in there. You just have egos. Who's in charge? I'm in charge. No, I'm in charge. No,
Yeah.
I'm in charge. Listen, I've learned we're deal guys. We've tried our own deals. We've tried our own stuff. There's money. I get that, but there's also ego. And you got to make sure both of those things work. Take the REITs. Like, there should be consolidation there.
Oh, yeah.
That's never going to happen. Or a privatization or something. And that's gonna be
I said this to Nate Terrell: Host and maybe Park, maybe one other should be publicly traded, because in today's age, if you don't have a market cap of at least 3-4 billion, who cares? And I think, you know, they all trade. Even Host trades at a severe discount to NAV. And so just on principle that, like, if you could take private, unlock NAV, there's a huge value transfer opportunity there. But there's a disjoint of incentive alignment between the board and the executive committee and shareholders that, you know, you could argue there should only be 2 or 3 publicly traded REITs lodging, and the rest should be taken private. But you're right. It's not going to happen because
I think a REIT's a tough. Sorry to cut you off. Keep going. Sorry. Keep going.
No. You're totally. I mean, I've said it many a time that, you know, 70% of the public lodging REITs shouldn't be public.
Agreed. I think it's fundamentally a bad structure. And again, we try not to shout it too loudly, but it's just bad. They're stuck. They can't renovate because it impacts EBITDA, which impacts their stock price, which impacts everything. And then they can't buy anything because their stock price is too low.
That's
And
right.
and then they can't sell anything because their stock price is too low. Because oh wait, you lost EBITDA. Now our stock price is gonna fall. So there's no incentive to really create and do anything. It's actually disincentive. And so they just sit there. And oh, by the way, the assets get older and older and older. And so then the brands are kind of stuck here because those assets aren't getting renovated. We need them to get renovated. And they're not going to. Say all the negative stuff about, yeah, hell, I'll even pick on private equity as you want, but their incentive to turn this thing over. Buy it,
Yeah.
fix it up, improve it, sell it, go do it again. Buy it, fix it up, improve it, sell it, go do it again. Those guys in theory can't hold either, and that they've been holding too long during this COVID. So that's part of the sellers today. Those guys that got to sell. Whoops, we should have traded it 3 years ago or 5 years ago. We didn't. We got caught. But I think that business model still works because let's go, let's improve it. And then the owner operators to me are your developers. They're fundamentally the developers, and they're going to build. And they're going to build, and they're either hold it forever or they'll build and sell it up to Wall Street, to the private equity or to REIT or somebody. Sell it up to private equity is really what I think is going to happen.
Yeah.
But they're not building today. The metrics don't work. They're off. You can't. It doesn't pencil. What it costs you to build, it's not worth it when you open, and it's supposed to be worth more. And today it's worth less. So if it's worth less, then why would you build it?
Yeah, I totally agree. I think I agree with 100% of what you just said. I am surprised that you haven't had a Blackstone who makes money on both sides of a transaction and 3 times with extended stay America that they haven't said, hey, we're just going to go take down 5 or 6 of these REITs, cobble it together in a private facility, and you literally would just make money on the arbitrage of the NAV. And I'm shocked that hasn't happened, but maybe I'm not in the weeds on some of the corporate governance and the poison pills that exist that are prohibitive of that happening. That's probably the limiting factor, but I'm just shocked that hasn't happened though.
So one, we agree and name every public, and they've tried, like they're all trying. They've been trying for 4 years now.
Yeah.
Or 5 years now. Like they're trying, they just haven't gotten there. And I do think it's a lot of those poison pills. And sometimes the math just isn't mathing, and sometimes you're just not willing to do it. But it's funny now. Now they're starting to get capital. I'll take the bet with you. Something's going to happen in the next, call it this year for fun, probably the next 18 months. But I think something in there is going to happen. They're starting to get enough capital in the system, right? All that debt capital that I talked about, there's enough.
Mhm.
I think there's some equity capital, and people see what you're talking about, so they're going to get some things. Something's going to happen.
Yeah, I'm surprised we haven't even. I mean, we've had some activism, but I'm surprised we haven't seen a lot more. Maybe we'll see more of that too.
Well, but even then, they really just wanted to go buy their stock back, right?
Yeah,
Like that's
exactly.
go buy your stock back. Well, that only has so much impact and diminishing returns. We agree the stock is cheap. Yeah, everybody kind of agrees with that. But you got to do something more than just buy your stock.
Well, I have to ask you. I ask every guest. AI, all the rage, driving the stock market. You got probably an IPO of OpenAI and Anthropic before we hit the end of the year. You know, when I turn on business podcasts, it's like 80% of the conversation.
Yeah.
We obviously live in a physical world of hotels and places. How are you thinking about AI? Are you guys maybe testing or using it at Hunter? And then how are you thinking about it from a demand gen and or margin improvement with hotels?
Yeah, I love it. We're in the real estate and people business, and yet we're talking about AI.
Yeah.
So just in general, one, I think AI is going to make us all more efficient and not put us all out of business. That's a thesis. We are using it in the firm, but it's in the back office, right? It's not so much in the hotel. I don't think it's going to be in the guest facing spot. It's going to be behind in the back
Do
office.
you use it for underwriting purposes? I'm curious. Do you guys use it?
100%. Yes, we are leaning in big time because we're efficient. We are half the size, if not a fraction of the size of our competitors, and yet we're doing more business than they are. In my opinion, depends on how you slice that, but we are doing more business. We're punching above our weight. We've been, because we're very efficient. My team is very talented, and we are leaning in. We can pivot and we can move. So we are using AI. My team is embracing AI. So how can we underwrite, instead of underwriting a hotel a day? How can we underwrite 2 hotels a day or 4 hotels a day? And it's with market analysis and market research. It can do it for you so much faster. We are building our own AI, with outside help, our own way of AI models and underwriting, so that one, you can just load the data in faster. because there's a lot, we get data dumps, if just lots of data, whether it's one
Oh
hotel
yeah, I
or
can
100
imagine.
hotels, like that's real work. So if we can automate that and get that input into Excel instead of us keying it in, there's still the art and science of it that I will say. And part of our strength is that, especially my analysts who've been doing this, and now the brokers, now the team, we can look at a hotel and tell you very quickly what we think that thing's worth. And then we kind of got to back into it and give support. But we've been doing it so much instinctively that we know what stuff is worth. Again, we're underwriting thousands of hotels. We'll sell 100 a year, but we're underwriting thousands. AI is never going to displace this. You and me in this connection. Yes, maybe we're going to, instead of doing this in person, we're doing it over Zoom. I get that, but it's not, I don't think it's going to replace. You're still going to need a person in between to actually get stuff done. Sales, psychology, human interaction, AI, in my opinion, can't take that away.
Agreed. And I also think in an AI world, if it makes people more productive, pending what it does with job creation, but it should lend itself to an expansion of travel demand. Travel is part of the human experience. We're explorers as a race. And so I very much believe that humans want to travel, see new places. And so travel is going to be up and to the right regardless of AI.
And I can show you a picture of a beautiful place. You don't get the emotional feel unless you are there.
Totally.
And that's
Yep.
what we're all going.
Yep. Physical places. Totally agree.
Whether it's the scenery or the culture or the people or the culture, drinking the wine and tasting the food, you can't do that remotely. You gotta be in it. So I agree with you. I'm super excited on the industry and very bullish. Thank goodness we're in this industry.
Yeah.
I do think you hit on a little bit. I'm going to say, I do think you can make the back office of the actual hotel more efficient using AI. And I think we need that. So that'll make these things more profitable and therefore more valuable. We're not there yet. Nobody's underwriting with that.
Right.
Because we haven't been able to prove it yet, but I think it's there. I'm optimistic that that's coming.
Yeah, there's probably a couple points in GOP simply in cutting G&A, maybe some rooms expense that no one's going to lose sleep over. I got to hit it. So you got Teague Talks season. You started in 2020. You've had a ton of big names on the show. I'm curious, as you reflect back on having done it for now multiple years, what are some, I'm new to this game. I'm just coming up on my year anniversary. Any words of wisdom to me on podcasting and any insights that you've gleaned that stood out?
One, it depends. I sort of know your audience. Start there. And so what do they want? We have done it all. I mean, it has now been 6 years. We're season 6. This is nuts. So we've learned a ton. I'm a big fan of the people and the stories. So this and what we're doing. We want to learn. Okay. Why we started this silly thing, right? One, it was COVID. Everyone was like, what are we doing right now? So in a time when we needed each other the most, we all ran home and shut down. I was like, no, we can't do this. We cannot do this. We got to talk. My phone was ringing off the hook. So I'm talking to my friends, clients. Everybody's freaking out. What I saw was you guys were all having the same conversation. So I couldn't have a conference, right? Because we all had to stay home. So this Zoom thing was the way that I thought we could get it out. I'm like,
that's right. You probably, your conference always falls like March or April. So you fell right in the dead zone of 2020.
We were the first conference to cancel. We were having conversations the Monday before, okay? With our advisory board, we were having daily 5 o'clock conference calls. We doing this or we not? And just fun. It was psychology. I'm telling you again, it was psychology. And in hindsight, it was somewhere political spectrum where you land. But even that is psychology. Half of the people were like, Teague, you can't do this. You're going to kill people. You can't do this. You got to be responsible. You got to shut down. I had an equal amount of people, equally as strong voices. Teague, we're the hotel industry. You have to hold this. You have to show people that we are still open for business and that we're moving forward. So it was real pressure. And on Thursday, the world shut down. The NBA got the COVID case and the world shut down.
Yeah. Any quotes or highlights to call out?
Oh God, I don't know. One is get good people. The guests are the secret sauce, right? It's not you and I, it's the guests. And for them sharing their stories, we love hearing the backstory. How did you get started? What hurdles, obstacles did you have to overcome? What do you see for the future? Like, you love the stories. I love that. And then just watching these people just grow. It's been awesome. And now we're doing the Teague Talk and the Teague Walk, but it's fun to watch. I mean, I just did Embassy Suites and Tempo in Pigeon Forge, Alpesh Patel at Kana. It is awesome. He was building $6 million Hamptons 20 years ago. And now he's built an $86 million embassy tempo.
Yeah.
And
Well, that's
spoiler
what's
alert,
cool about this industry too, that you can really come from very humble beginnings.
so that's and you sit down with Horrendous, very good friend, very successful. They did same thing, Little Hamptons. Now he's doing the hiatus down in St. Pete Beach. It's an awesome property. He doesn't want to come on. He's shy. He's like, T, never come on. You're never. He won't speak at my conference. He won't anything. I finally get him to come on. His story is incredible. It's amazing. And everybody loved it and they all ate it up. And he's a humble, very humble human being, but just listening to those stories really, really catch people. And the other ones, so Andre Zodoff, who runs, is the opposite of that, right? He runs strategic. He calls us and it's like, Teague, we've just finished this region. The brand calls us. We want you to come walk our brand new region in Santa Monica. I'm like, okay, all right, we'll show up. I don't know where this is going to go. Let's see. It was a Lowe's hotel in Santa Monica. Everybody knows it. It's an iconic, amazing hotel.
I know it well. Yeah.
They bought it. They yanked the flag off. They did the opposite. They combined rooms. They shrunk the room count. They made 2 rooms into 1, 3 rooms into 1. He spent a fortune renovating that hotel. I was like, this was a great hotel. You didn't need to do this. And it's the story. Well, what's your capital? Oh, well, our capital is China, by the way. I'm like, you got to have the right capital partner who allows you to do this. And that hotel is unbelievable. I was just out there over Easter with my family. My daughter's in school out in LA. So we're just out there and it's fantastic. And who would have had the guts or whatever? No underwriting pencils to that. It just doesn't.
No, I can't think of a time that I dramatically shrunk the key count of a hotel. It's often the opposite. Hey, can we turn this closet into a room?
Correct. Revenue per square foot.
Yes. Well, I appreciate the advice. That's great. Well, we've come to the part of the show that I like to close out with a little bit of rapid fire. No wrong, right answer. So, best hotel.
So I don't rapid anything, but let's try it.
Okay.
Fifth Avenue Hotel, Alex Oheb Shalom in New York. Total passion project. Ridiculous.
I'm going to check it out. I have not been there.
6-star hotel. You're like, what is that? And it's in New York and no one's ever heard of it. And it is over the top.
Very cool. We'll check it out.
He's a name no one's heard of. He's just a guy. So Alex is probably there on site. So if you go, ask for Alex.
You can only pick one. A deal that you're most proud of closing.
Oh, cop out. But I'm going to say it's Motel 6, which that's why it's kind of fun. But Blackstone hired us to help them, one, buy Motel 6, but then for 10 years, unravel it and sell it piece by piece. And they brought on Rob Paleschi, who was at Hilton. So friend of Blackstone, brought on Rob to run a Motel 6. And in 4 years, we sold 500 hotels and the brand. And that was all started before COVID, 2019, then during COVID, then ended in 22. We got lucky. We sold the last one right at the peak. And that was everything from, I said Motel 6, but I'm talking $1 billion. It was really $2.5 billion, but we had a bid for $1 billion to buy the remaining assets. And we were all like, yes, this was in 21. And we were like, yes, maybe even 21. We were like, do it. John Gray said no. The joke with everyone is John Gray is always right. He was lucky. We sold the balance, onesie twosies or 10 packs and 20 packs, but we sold it. We got it done by June of 22. And I think we sold it for like $1.3 billion. So John was right. He made himself an extra 30% by holding on. But if he'd held on a little bit longer, it would have gone the other way.
Yeah. Well, timing is everything. Most overrated market for hotel investment.
We probably did this already, didn't we? But
most overrated market, if you just had to call out one.
Nashville.
Okay. Most underrated, if you had to just call out one.
Greenville.
A cap rate on a Hampton Inn off Interstate 37 in Corpus Christi today. What do you tell that owner?
Cap rate.
Yeah. So Hampton Inn off of I-37 in Corpus Christi. Sorry, this is a curveball. I can't believe I'm doing this. What do you tell that owner?
But I have the
Yeah.
It depends. The 8 is sort of if I had to slap a number on it, but it's that triangulation that it's give me your per key, give me your price per key, give me your room revenue multiplier. Those need to triangulate to actually make it sort of make sense. And that's probably a 3.5 multiplier. Golly, depending on the age of that Hampton, it's in the 150,000 a key, 170,000 a key. If it's not working, it's the opposite of that. It's 100,000 a key. If it's older, if it's in the 2000 range. If it's older, then it's going to be less. Because you got to remember that the ones in the 90s, they built for 50,000 a key.
Yeah.
So to be worth 100,000 a key today is a great number.
Yeah. No, that's good advice.
Probably not, but
yeah, no, I think given no context, I think you did well. Best career advice you've ever gotten?
I don't know. It's probably stay humble, but stay aggressive. Keep reaching to the stars, but also know who's helped get you there and bring them along with you.
Yeah, that's well said. Well, Teague Hunter, my friend, thank you for being here. We close every show with what you're not done with. So, Teague, what are you not done with?
Well, three things. One, I'm not done asking you questions. I feel like I should flip this script and start poking you for the same stuff. The other two things, and I mean this, one, I don't think I'm done doing deals. There's a high that you get when you do deals, when you chase that deal and it seemed like it wasn't going to happen, and then you get it and you get it done, you get it closed. So I'm not done. And even though in my work life, I'm spending too much time managing the team, growing the team, doing Teague Talks, running conferences, doing all kinds of stuff on a macro level, that 1% that CEOs should be thinking of on a regular basis. I'm spending probably too much time on that, but I still love doing deals. So I'm not done doing deals. They got to be bigger and sexier, just like the gambling bets. They got to get bigger to get your juices going. But I still am not done doing deals. And then the other one that I don't know, I just popped in my brain, but I'm not done, probably because I just talked to her. But I'm not done being a father. My daughter, I got one daughter. She's a sophomore in college out in California. She doesn't call her father enough. She should. But
where's she in school at?
She's at Loyola Marymount in Santa Monica.
Excellent.
So she loves it. She's trying to do the film stuff, acting. That's why she's out there. She's doing a nice. You raise them to be independent, strong personality, strong-willed, independent, and she is. Check. But so yay, great. But she still calls her father every now and then for help and advice. So I love that.
Well, that's awesome. I love it. Well, thanks for being here, my friend.
Sloan, you're the best. I'm proud of you for this podcast that you're pulling off. You do it.
Thank you. I'm just trying to catch up to you, my friend.
No, there's room for everybody. It's a big tent. Thanks, brother.